First of all, let me see what's going on in our investment competition. I know there are a lot of investment competitions going on right now, including ours. So let me just see what's going on with ours right now, because this market has been particularly tough. And we're going to talk about why and how long that's going to last. Now, this is an investment competition, as are the other investment competitions. So, all right, bear in mind that you do have to actually do the investing. You have to make the investments. So that's a requirement. And for our investment competition, you only have to be like half invested by the midterm and fully invested by the end. I would say that for the other investment competitions, that's less true, although the latter would be true, that you should be fully invested by the final. If it's a competition where the client is giving you money to invest, you have to invest the money. Don't stay in cash, don't have anything in cash, or you're going to fail. So don't do that. It doesn't matter what your performance is, the long-term investment strategy. And over the long term, stocks go up more than anything else. So having said that, for our investment competition, be 50% invested by the midterm. For other investment competitions, there are also requirements by the midterm. You have to have your first stock trades by a certain date, which is going to be like the second or third week. By the fifth week, you have to give your midterm report. So make sure you follow the rules. Make sure you follow the guidelines. A majority of teams get disqualified because they don't follow the rules and they don't follow the guidelines. Make your trades on time. Invest in at least one stock per teammate per sector. If you disinvest from one sector, make sure you buy another stock in that sector or a different sector, so you have as many sectors as you have teammates. That's very important. But make sure you follow the timeline and get everything done. For those competitions that have an aspect that has a client analysis, make sure you do the client analysis. Don't simply restate the case, because that's silly. Now ours, you're going to have to do a lot more work in terms of sustainability and in terms of diversification and things like that. Make sure you pay attention to those things, because there will be a sustainability judgment at the end of the competition. It's not just about having the best performance, okay? All right, so let me flip over here real quick to see what's going on. I'll share my screen with you. You can see exactly what I'm looking at. So we can see what's going on with our investment competition. Come on, share screen, come on. You can do it. Oh, so here's my dashboard, so I can see what's going on. And look, you guys, I've been showing you like the inflation chart every week for the past several weeks. And you can see that it's companies like General Mills and Kellogg's that are just raising prices like crazy. And those stocks actually went up a lot. I don't know why you guys are buying Apple and Tesla. This isn't 2020. This isn't 2021. This is 2022. Things are different. Amazon, Microsoft, and NVIDIA are not good investment picks right here. We all know what happened with these companies. They were temporary tailwinds. That's what somebody like Benjamin Graham or Warren Buffett or Charlie Munger would call this situation. When we had our lockdowns and everybody had to work from home and everybody went to school from home, we all had to buy new laptops. We all had to buy and update our software, get new software subscriptions, software as a service, get new routers, upgrade our bandwidth on our routers and our that would even entail your cable company perhaps. But the point is this, everybody's done that now. There's nothing else we need to upgrade. Everybody's got a new laptop and new software and good internet service from home. Now that the lockdowns are over, people want to go on vacation. That's why airfares are up so much. People are leaving the home and going out finally. So I know that when I'm looking at this list of the top traded securities. Yes, I know NVIDIA and Microsoft and Amazon and Apple did really well during COVID and did really well during lockdowns. But that was a temporary thing. Those growth trends, they went off the charts. And people thought they were going to continue forever, but they're not. They went like that. And now they're going back the other direction. Well, not for Apple. Okay, Apple's got new iPhones that are really good, and I'm probably going to get one, I'll be honest. But now, having said that, for the others, let's think about NVIDIA for 1 second. Now, geez, wow, this chart's really wide because this goes to 86. You guys made 86 Tesla trades, really? All right, 25 NVIDIA trades. All right, I'm not even Italian, but I'm going to say Mamma Mia. Hey, 25 NVIDIA trades. What's going on here? Come on, you guys. Look, all right, we all know that when everybody was staying home, people needed new graphics cards. Okay. Also, Bitcoin was like $60,000, $70,000, $80,000. And everybody wanted to set up a mining rig using graphics cards from NVIDIA. And now Bitcoin's like, I don't know, where is it today? Like 19,000. It's not worth it buying NVIDIA graphics cards anymore. People are shutting down their mining rigs. They're dumping their used NVIDIA graphics cards onto the market. Sales are collapsing. Inventories are building up just like they are we already heard it from the retailers. We heard it from Target. We heard it from Walmart. And this week, and we'll talk about this in a second, we heard it from some other companies. Inventories are building up. People are spending the same amount of money, but because things cost so much more, they're not buying as many things. And that's causing demand destruction. And retailers are now having to liquidate assets. Manufacturers are probably going to start laying people off. We're already seeing it in the tech space. Nobody could buy graphics cards. People were double and triple ordering. Nobody could buy microchips of the most basic kind, even the kind that runs the dashboard in your pickup truck. And that's why Ford and GM had so many cars that they built that they couldn't sell because they didn't have enough microchips. And so they were buying the basic ones from AMD, from ARM, from Intel, NVIDIA, anybody who can make a microchip. They were triple, quadruple ordering. And now that they're getting microchips, canceling all those orders, demand is collapsing for these companies. All right, so I don't want you guys to get upset when you buy all these tech companies like NVIDIA, Microsoft, Amazon, Apple, and the stocks go down because they're actually good companies and they're all profitable. And I think over the long term, they're going to be around. It's the younger companies that don't have positive cash flow and don't have profits that probably won't survive this market cycle. Nonetheless, please think this through. These stocks were really high PE multiples because the earnings were going up so much. Now the earnings are not going up. People are shocked, I say. That's a line from Casablanca. If you don't know, ask your mom. Shocked to find out there's gambling going on at this institution. So they're shocked to find out that earnings can actually go down for these companies. And because of that, the PE multiples are compressing from 30 to 25 to 20 and going to 15 and probably maybe going below that. I don't know. But be prudent, please. You can't pick yesterday's stocks because they went up. I know that Tesla went up a lot at one point and NVIDIA was a red hot stock. I know Apple and Amazon were red hot stocks a couple of years ago. It doesn't mean they're going to be red hot stocks this year. So please think about what's going to happen in the future. Right now, we're in an inflationary environment where people's behavior is changing. They want to go out. There have been weddings that have been put off for 2-3 years, reunions, class reunions, family reunions, whatever. Just meeting your friends, going on vacation. So that's why things like airfares are going up so much right now because people are traveling a lot more. Hotel rates have been going up a lot because people are traveling a lot more. And not for business. They just want to get out of the house because we've all been trapped in the house so long using Apple, Amazon, Netflix, Microsoft, and NVIDIA. I'm surprised Netflix isn't even on this list, to be honest. But Apple and Tesla, yeah. Normally when I have a rookie class and people haven't talked about anything yet, those are the two top stocks. All right, so let's look at the rankings real quick because I want to see how you guys are doing in our investment competition. And just leave it to my browser to freeze up right now when I'm in the middle of this webinar. Oh, here we go. Oh, You know, some of you guys have been doing pretty well. Now, I'm not going to click on everybody's portfolio and show you what everybody's been buying because I don't want you to copy other people. I'm going to look, but I'm not going to copy anybody. Some people are actually up, even in this horrible, horrible environment, and that's pretty good. Even some people who've made a substantial number of trades, 29 trades. That's pretty good. 10 trades, 14 trades. Some people are doing quite nicely. A lot of people, no trades yet. That's not a way to win an investment competition, okay? But honestly, I expect that when I click on this last two tabs, that's where I'm gonna find most people. Yeah, so we got a few people who are down a little bit, and that's not unexpected. Look, it's a tough market. It's a really tough market. It is what it is. And so look, I'm not gonna shame anybody. It is what it is. It's a tough market. And let's talk about the reasons why it's been so tough. Caillou asks me in a direct message, how do you explain Carnival Cruise Line's earnings? The reason Carnival Cruise Lines are, only thing you ask about that, because I just had a conversation with my brother who lives in Georgia, and he's going on a Carnival cruise right now, and he can't wait. So prices are low. Taking advantage of the situation. Okay, so let me put some slides up, and we'll talk about what's been going on in the market. And let me be honest, it's a difficult environment, and not just for tech stocks. Things are getting dicey, and they're getting dicey in areas where we don't want them to get dicey. And I'm talking about they're getting bad in the financial markets, and in particular in Switzerland and the United Kingdom. So let's look at the news that we've had recently. So this is the S&P 500 this week. Well, oh my goodness. All right, so yeah, hopefully it'll stay on that slide for more than 1 second. And what we can see is that the market continually tries to rally. Everybody wants there to be a bear market rally. Everybody wants there to be a bear market rally. And so, you'll get these horrible downtrends, and then everybody will be like, oh, that must be the bottom. Yay. And collapse. And this is a case of good news is bad news. We'll talk about this in a second, but the economic news that came out today was actually pretty good. But that's bad news for investors and bad news for the market, because that means the Fed's going to continue to raise interest rates until morale improves. The beatings will continue until morale improves. So Adele, I see your question in the chat. I'll answer you in just a minute, okay? But let me continue with the slides for just a second. But congratulations for putting in a trailing stop trade. That's really good. You can figure it out. You can do it in percentage terms or dollar terms. Okay, so this is the market this week. It's been really choppy and really, really tough. And we are currently in an environment where good news is bad news. Anytime there's good economic data, the Fed is going to raise more. And we saw that last week, and when I showed you the dot plot, where they actually, all the Fed governors who have a vote increased their estimate of where interest rates are going to be next year. And that's what really spooked the market. It wasn't just that they were raising again, because we all knew they were going to raise, but they increased their estimate of where we were going to be this time next year. And that's spooking the market. And I think rightfully so, because I'm going to play you a clip from our esteemed Wharton professor, Jeremy Siegel, again, where he went on a rant. And I should have, I played some clips from him before, but this is an epic one, an epic rant. And I'm starting to think he's right, where the Fed is looking in the rearview mirror and they're driving a bus. We're all in the same bus. They're driving the bus, looking in the rearview mirror, and you know what's going to happen? They're going to crash. And we're starting to see those kind of stress points where they're bouncing off of things already, or causing others to. They're hitting the other cars on the side of the street, like Switzerland and the UK right now. And the UK and Switzerland are getting beaten up. So, all right. So, trailing 12 months. Okay, look, it's been a tough year. And I know everybody wants there to be a bear market rally. Bear market rally, yay. Bear market rally, yeah. No, no, we're still in a bear market, and we're at our lows. We're beyond our June lows at this point, and it's official. We're in a bear market, and there's no getting around that. And usually things like this start when future expectations soften, and that's what's happening. The worry that future expectations are going to soften is what's driving the market so far. So our PE levels have been coming down. Our PE ratios have been compressing. But that's just the P in the PE ratio, right? The P is the price. The prices have been coming down. But the earnings, the E part, the denominator hasn't been going down. So we've seen the PE ratios compressing, but they're going to go inflate back up again when the E gets cut in half, because earnings are going to come down when companies start to roll over their debt and have to issue new bonds at 3 or 4 times the interest rate they were formerly paying, or their floating rate debt, the price goes up, or they can't get funding, and so they have to issue stock and at a dilutive price, which cuts their EPS estimate in half. There's going to be dislocation in this market. All right, so I'm going to repeat this slide every week. We'll make stocks go up and down, a lot of different things, but earnings, companies have earnings. And when they have earnings, sometimes they pay dividends. All right, look for dividends, look for stocks with earnings and dividends. It's important. Hopefully those earnings are going up. Hopefully you're invested in a company that's on the right side of this inflation trade, and they're raising their prices right now. Oh, it's a loud siren. Hope that's not messing up my broadcast. Earnings increases, dividend increases, these are good signs. Changes in growth rates, okay? This is our future expectations. And remember, this is you know, it comes back to this. It's not about you. When you buy a stock, you don't get the earnings that just happened. That's the other guy's problem. You get the future earnings, and that's the part you have to figure out. It's the earnings expectations, and that all comes down to growth rates, earnings growth rates, revenue growth rates, things like that. And of course, changes in interest rates, because we have to discount our securities using a discount rate. We have to take those future earnings and those future cash flows and discount them back to the present value, right? We have to use the present value formula. We take those future expectations, we discount them using a discount rate. But if that discount rate goes up, and it does go up, then we have to reduce the amount that we think that future cash flow is worth. And they're going up because there are competitive investments. Right now, it's kind of getting compelling to invest in stocks, but it's also getting more compelling to invest in bonds right now. You can get risk-free treasuries at a 4% yield right now. And short-term ones, I'm saying 2-year treasuries. There's not a whole lot of interest rate risk on 2-year treasuries, and the yield is compelling. You can just sit back and relax and watch the market collapse, stay safe and sound, and 2 years later, get your money back plus your 4% every year, and boom, then you get back into stocks. And that's what a lot of investors are doing right now. And yeah, it all comes down to our future expectations. Beep, 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 beep. So, okay, so it was the PE ratio where it was the P, the price that was coming down. And if you remember, if you took any classes with me, we talked about this previously. We were greater than 22 times at some point, just not a few months ago. And that's come down to 21, 20, 19, 18, 17. Now we're getting to the point where it's like, well, stocks are getting pretty cheap. The problem is that the reason the price is coming down is because everybody's waiting for the other proverbial shoe to drop, right? You already heard the clump when the price came down, but the guy upstairs is going to drop his other shoe on your ceiling, and it's going to go clump again, and that's when this gets cut in half. And that's going to make this double. You're going to be back at 34 in no time. So we got to work. We got to really look out for this. We got to be worried about earnings coming down. And here we are. Here's the annual change in earnings. It's not looking good, everyone. Earnings estimates are finally starting to come down. They're not negative yet. I mean, this is our change in forward earnings on our left axis. And you can see that our earnings expectations have been lowered, but we're not negative. But I mean, obviously you can see the trajectory here. And if history is any guide, you can see what happens when we have that kind of a rollover. You know, this is not a good sign when you have these rollovers. You know, when you have these rollovers, things tend to go in a certain direction for a while until something breaks that momentum. And so right now we're facing a situation where earnings expectations are driving lower. That's compressing the PE ratio first, but the PE ratio is going to be much higher when the earnings component, the denominator, gets cut in half, which it isn't yet, but we're looking like we're getting close to that happening. All right, so this past week, we had an interesting interview with Professor Jeremy Siegel from Wharton School, and they're calling it They're Nuts, They Know Nothing 2.0. But just for fun, for kicks, I wanna start with They Know Nuts, They Know Nothing 1.0. The first time this happened, because many of you are probably too young to remember this, but right before the housing crisis, before the housing bubble popped, and before the Great Recession, the Great Financial Crisis of 2008, 2009 happened, and the market lows where everybody was selling everything. Everything was going down at the same time. Everything was, you know, there was no place to hide. This was this is what made Jim Cramer famous. I mean, he was famous already. He had a TV show, but he had this blow up on TV where he literally exploded. And this poor reporter was trying to maintain a straight face and keep things under control. He knew what was going on, and he'd been talking to people. And when you get to a certain point where you're trying to slow the economy and raise rates, it has unintended consequences. And there were fractures developing in the financial markets, and he knew it, and he made that point clear. So before I show you this clip from Professor Siegel, let's just revisit the historical one, because Bill Pool is shameful. That's actually my favorite line from this.
Everything sort of starts out down a little bit, but nothing to worry about. Boring summer fight. Almost, you know, a day we haven't had in a long time. Just not exciting. Then all of a sudden S&P says, ooh, we're worried about bear. Bear goes down, market goes down. And then all of a sudden things kind of calm down. Bear comes out and says, hey, we're okay, guys, we're okay, everything's fine. Bear goes back up to neutral, market's only down 20. Then Bear comes out and says, oh, worst bond market in 22 years. And that's where we are right now. The market's down 100 points. How do you trade this?
Remember the Bear Stearns. You got to adopt a Henry Ford attitude here, which is never explain, never complain. And they didn't do that. You keep your mouth shut during this period. You don't say a thing, because you're going to say something that people don't like.
And we say, hey, come on, guys,
keep your mouth shut.
Come out here and talk about your exposure.
No, you speak softly, and you wait to that level where you think the shorts have overdone the stock, and then you do what Dick Fold did in 1998. You pick up the phone to guys like me, and you say, 32 bid, 1 million, and then you get whacked, and you come back and say 31 bid for 2 million. They're not doing that. That inspires more fear. I don't want to create fear. I like Bear Stearns very much, but I think that at this stage, this is not a good call. They shouldn't have done it, and they should have just said, you know what, we're doing well, and don't say another thing. Just don't say it, because it does not inspire confidence to have 10 headlines coming over about what to do. I don't like it.
All right, I hear you. Now, I still, though, when we said,
and
hey,
look, the Dow can rally. We've seen the Dow rally.
No, I know. I'm not even, but I mean, it's just interesting, this bigger.
Well, this is about Bernanke. This is about Bernanke. He has to be on that call. Forget the investors. The investors are going to do, if Bernanke needs to open the discount window. That's how bad things are out there. Bernanke needs to focus on this. Alan Greenspan told everyone to take a teaser rate and then raise the rate 17 times. And Bernanke is being an academic. It is no time to be an academic. It is time to get on the Bear Stearns call. Listen, open the darn Fed window. He has no...
So something similar happened this past week, and I think we should talk about it. And it's not just because some of you are participating in the investment competition where this gentleman is a professor. I'm just saying that people are seeing strain in the economy, and they're upset that the Fed's doing the same thing. They're not paying attention, and they're going to cause problems. And so let's just watch this clip, because this is more informative for what's going on right now.
Professor Jeremy Siegel of the Wharton School. He joins us right now. Professor, it's good to see you again. What are your thoughts as we watch these lows of June at least be taken out from the Dow standpoint, and maybe in the days ahead we find the other major averages in the same precarious place?
Yeah, certainly. Scott, I find it very amusing. A year ago at that September meeting, when we had booming commodity prices, when housing prices rising at the fastest rate in post-war history, when we had all commodities going up at rapid rates, Fed Chairman Powell and the Fed said, we don't see any inflation. We see no need to raise interest rates in 2022. Now, when all those very same commodities and asset prices are going down, he sees, stubborn inflation that requires the Fed to stay tight all the way through 2023. Makes absolutely no sense to me whatsoever. Way too tight. We do not have to get anywhere near that level to stop inflation, because all the inflation is basically stopped. It's basically stopped. I mean, you had a headline just came across 3 minutes ago, oil back to January levels. That's before Russia invaded Ukraine. You can see what's happening to commodities. We're going to get the Case-Shiller index next week. It's going to show no increase or a decrease for the first time in years. And that's a lagged indicator. On the ground, commodity, all the prices are going down. The only thing that's not going down is wages. And by the way, wages are in catch-up mode. Don't argue they're pushing inflation. They're lagging inflation. I mean, the workers are trying to get what a little bit back of what the inflation happens to be. I think the Fed is just way too tight. They're making exactly the same mistake on the other side that they made a year ago.
There are those who agree with you, who think that the Fed is oversteering.
Yeah,
but
absolutely.
But saying it doesn't do anything for the scenario that we're currently in. If they continue to do it, whether you think it's right or wrong, if they continue to do it, what does it mean for stocks?
Well, until he sees the light and says, you know what, I don't think we have to be so tight. Until that happens, you can still have pressure on stocks. I mean, and that's gonna, that's probably one of the factors that can see the light. I mean, when he sees how high real rates have gone, the dollar the highest in 20 or 30 years. By the way, next Tuesday we're going to get the monthly stock market money supply data, which is going to show the greatest decline in 5 months that we've had in the post-war period. I mean, if he looks at any of the monetary or financial indicators, he can't say, oh, we have to keep them on. I mean, at his press conference, he said, we have to get real rates into positive territory. They're in positive territory for every maturity. For the first time in years, we're already there. I thought that was the most uninformative. And no one was asking him a hard question. How do we have 3.2 million new workers and GDP going down? What does that mean? What does the record decline in the money supply mean? I mean, what does the collapse in commodity prices mean? What is the lag construction of these housing indicators that are 40% of the core inflation, which are going to filter through inflation for the next 12 to 15 months. Is that what he's looking at? Why is he looking at that? That's not an accurate view of what housing inflation is. I mean, there were no hard questions. There were 50 reporters there. I don't know. They basically said, repeat the statement you made at the beginning. There's so many things I ask him. What is he actually looking at? I mean, he's looking at 3-month annualized core inflation that is a lag. Well, we all look at market. I mean, look at what does the stock market do? It looks at market-oriented data. And that's what
Professor,
the Fed should be looking at.
I don't know that I've seen you this animated. You seem downright
I am very
angry
upset. Yes, I am. I'm afraid it's like a pendulum. They were way too easy, as I've told you and many others through 2020, 2021. And now, oh my God, we're going to be real tough guys until we crush the economy. I mean, that is just, to me, absolutely poor monetary policy would be an understatement.
Woo! Oh man. Yeah, he's upset, and I think rightfully so. All right, yeah. So Kai, you asked me in the chat the difference between a yield and a real yield. And okay, so for anything, for a stock or a bond, the yield is the nominal yield is the interest or dividend you receive divided by the price, right? And the real yield is that percentage minus the rate of inflation. And so that's what he was talking about. That's what Professor Siegel was alluding to in that conversation. I'll call it a rant, where he's talking about how inflation rates for most things is now coming down. And so real yields, because the Fed is pushing interest rates above 4%, real yields are now in positive territory. That's what he means. So the nominal yield would be 4. If inflation were 2, then the real yield would be the nominal yield of 4 minus the inflation rate of 2, which would give you a real yield of 2. That's all. That's what a real yield is. That's what he was talking about. So yeah, thanks for the question. Very timely question. Very good. So anyway, I don't know how long I want to play this clip, but I mean, seriously, things are getting out of control, and I don't think people are paying enough attention. Oh, let me turn my camera back on, sorry. I don't think people are paying enough attention in this country of how bad things are getting in other countries. And this happens almost every single time we go through one of these tightening cycles. And what happens is, yeah, Kai, you asked, will Credit Suisse go under? And that is the big question right now. I mean, we can look at that stock price. Last time I checked, it was $3 and change. There's a run at the bank at Credit Suisse right now. And the more people say that, the more there's going to be a run at the bank. And then, therefore, the more likely people are not going to do trades with them. And the more likely they're going to end up like Lehman Brothers or Bear Stearns. Will the Swiss government bail them out? I don't know. I hope so. But we already had a bailout this week in the United Kingdom. And this is not a UK report, because, of course, in the UK, they don't want to talk about this. This is an Australian news report. But there's a financial meltdown happening now as we speak. So I know that every time I've talked to you for the last several weeks, I've been bearish on the market, and I'm telling you all these bad things that are happening. But unfortunately, things are not getting better. And before I'm bullish on the market again, I want things to at least get less worse, right? At least bottom out and get less worse. And maybe if they start getting better, then maybe I'll be like, okay, maybe stocks are cheap now and it's time to start buying stocks. The problem is that things keep getting worse and worse. They're really bad. Sorry for my slow internet connection. Apparently it's going to take a while to load this video clip. But it's really telling in that the United Kingdom, the pound sterling, is getting crushed so badly that the
While we were sleeping last night, the UK economy faced a major financial crisis, only averted by an extraordinary intervention by the Bank of England.
A warning from the IMF, central bank intervention, disorderly currency movements.
You would expect the combination you just cited to appear in a struggling developing country with weak institutions.
Some are claiming the UK came close to a Lehman-style collapse. Well, what's actually happened? In the simplest terms, last week, the new government's astonishingly large tax cuts and plans to borrow sparked a collapse in the pound and surge in government borrowing costs. As this chart shows, prices of UK government bonds collapsed, while the yields or the interest paid on them rocketed to levels not seen since the GFC. It's reflecting markets' nerves around the government's ability to repay. These bonds are central to the UK's financial system and influence the price of all other assets, but are particularly key to the stability of UK pension funds. Overnight, those funds were in crisis, and the Bank of England finally declared the market dysfunctional and stepped in with billions of pounds to prop it up. Now, there's not a lot going for the sinking pound. It's at historic lows against the US and a 5-year low against the Aussie. Well, joining me now is Commonwealth Bank's Head of Fixed Income and Rate Strategy, Martin Wetton. Marty, thank you so much for your time. Is it overstating it to say the UK came close to a Lehman's event?
It would be overstating it to say it was that dramatic, but it was certainly one of the most extraordinary things we've seen in quite some years, and certainly in terms of the move in the markets. That's something we've actually never seen before, particularly in the UK gilt, which is what gilt market, which is what's known as their bond market.
Why are UK pension funds at the centre of the crisis?
All right. Well, we don't need to know more about UK pension funds, but I just wanted you to hear what was going on here. So things are getting worse, not better. And so here's one of the things that, let me turn my camera back on. Here's one of the things Jeremy Siegel was talking about. So, I mean, the reason we have inflation, we all know. This is the Federal Reserve Economic Database from Federal Reserve St. Louis. We've all talked about this before. You can get all this data for free for your programs in Python or R or JavaScript or whatever you want to run your program in. And you can see there's been a slow but steady, as the economy grows, the amount of money grows, because you need a certain amount of money to sustain the economy. Anyway, during COVID lockdowns, we blew out the money supply, and then the party didn't stop. We had all these stimulus packages. We had all kinds of fun stuff like infrastructure and stuff like that. And well, the money supply, it wasn't just the government spending. A lot of it was the government spending, to be honest. But also the Federal Reserve stepped in and was buying bonds. They were buying treasuries and they were buying mortgage bonds with money that didn't actually exist. And so they were basically creating money out of thin air. And that's where you saw this really big move right here. And then they tapered their purchases. And now the thing that Jeremy Siegel is most upset about is it's not just that commodity prices are stopping and things are slowing down. It's that things are going in this direction. And we've never really experienced a money supply decrease of this magnitude, and it's going to be painful. They're basically taking money away. And in an effort to get inflation under control very quickly, the Federal Reserve is basically just taking the money off the table and walking away. And so are prices going to go down? Well, I don't know. We'll see. But prices of bonds and prices of stocks are definitely going to go down if there's no money left to invest in these things. Other assets maybe as well, maybe real estate. And this is where we're headed right now. So look, just it's almost quarter up. I don't want to go on too much more than half an hour, 45 minutes. So just to give you an update where we are in the market right now, here's the other leading economic indicators. Things are, when they roll over, things get recessionary. When they roll over, things get recessionary. When they roll over, things get recessionary. When they roll over, all right, you do the math. We already had 2 negative months of GDP And the government still hasn't said there's a recession. But guess what? It's here. Yeah. So basically, when you see these red lines, it's here. And, you know, maybe the government won't admit it because it's an election cycle, but the other private think tanks and economic forums, they all know what's going on. You see this blue line below 0, that means things bad. So it's going to be tough for the market. And it's tough even when companies do really well. Now, here's a great example. Now, I posted about this in the YEFA server on Discord, where we had a situation where a company beat on the top line and it beat on the bottom line. Look, the EPS consensus forecast was for 91 cents per share. And they put in a great number, great performance, 93 cents per share. But the guidance wasn't good. And the worst part was that on the balance sheet, right, so they sold a lot more stuff, They sold stuff at higher prices, but they didn't sell as much stuff. Let's put it that way. That's a better way to put it. And so the inventory kind of ballooned out by like 40%. And now they have a bunch of stuff in inventory that they can't sell, and they're going to have to sell at a discount. And so, you know, I posted this message. Nike beats on the top. Well, that's a typo by me, sorry. Top and bottom lines, but margin shrank, which is bad, and inventories blew out 44%. And so, like I always say when we have our class, when you see inventories rising like that, there's usually a problem. Something stinks. Just like we saw with all of these retailers, and it's been going through all of them, not just Walmart and Target, but several others. And this is what's going to happen to your stock. If you see inventories blowing up by 44%, it means you're making a lot of stuff and tying up a lot of cash in things that you can't sell. And that's bad. And you're going to have to mark that inventory down by put it on sale for 50 cents in the dollar because there's no way to get rid of it and get your money back otherwise. And so even though the stock beat earnings, they were expecting 91 cents and they got 93 cents. And what happened to the stock? Crater because of inventory blowout. So I know normally, as an analyst, I'll be honest, like normally inventory is not something I look at, but I always tell people about it because there are certain times when you need to pay attention to inventories. And this is one of those times when you see a retailer or a consumer discretionary company and their inventory on their balance sheet starts blowing out like that, and the inventory turns are going down and inventory levels are going up, you can bet that the stock is going to get punished. It's just going to get punished. There's no way around it. Okay, so let's talk about future expectations. Here's what happened this week. And oh boy, obviously GDP was not a great thing. Also, here's the other thing. So first of all, GDP was high and initial job, but that was a revision. That's not a first time. So this was not new news. This was a revision, but it was high. It was very high. It was up, right? They raised it. But here are the jobless claims. And this is what the Fed is trying to reduce now. They're trying to reduce wage growth by getting initial jobless claims a little bit higher so that the number of people who are out of work kind of matches with the number of job openings, and therefore wages aren't going through the roof by people just asking for raises, or they're going to quit and go somewhere else for a 10, 20% raise. So here's what happened. The consensus was for 215,000, which was up from the 209,000 previously. But it came in much lower, 193,000. I know it doesn't seem like a lot, but it's a classic situation of good news, bad news. Well, I mean, this is bad news, and that's bad. This is bad news is bad news. This is good news is bad news, because that means the Fed's going to raise rates more. Surprisingly lower unemployment claims, that'll be a rate hike. Cha-ching! The writing's on the wall now. All right, and then what do we have? Oh, PCE, consumer spending. Oh my goodness. And so things just keep, they keep not slowing down. Now, this is actually consumer price index is what you and I look at, the CPI. But the PCE is the number that the Federal Reserve looks at, the personal consumer expenditures. That's what this number is. And it was supposed to be down, but it was up again. So people continue to spend more and more money, and that's inflationary. So personal spending, I mean, these things all go hand in hand. They're all part of the same report. Personal spending was down, and now it's up. And they're not buying a greater number of things. They're just spending more money on things. And this is what the Fed's concerned about. This is why they're putting pressure on the economy. Hopefully it doesn't break something in Switzerland or the United Kingdom. Because, you know, here's the problem we're having right now. We had that nice bear market rally, but we're all taking a detour right now and crashing and burning. All right, so here's what we got coming up next week. Here's what we need to pay attention to. There are probably going to be Fed speeches. We need to pay attention to what the Fed governors are saying. But we've got producer price index. We've got the minutes from the Fed meeting. These are all going to drive the market. We've got core inflation rate coming up. We need to pay attention to see if this is going down. If this starts going down, then hopefully the market will start to rally again. And I imagine if we get a couple of good data points on Wednesday or Thursday, maybe the market will start to rally again and we'll be in a good position. And then on Friday, we get retail sales. Again, same kind of thing. I know that when retail sales are positive, it looks like the economy is growing. But again, if it's just because prices are up, but people are buying fewer things, that's negative for the economy. So we need to be cognizant of that fact. But nonetheless, and this has been a bright spot, this consumer confidence number, consumer sentiment, that's been going higher because some prices are coming down. And consumers know when, you know, the price of milk and eggs isn't going up anymore, it's flattening out, and the price of gas is coming down, then things are not getting worse. And that's what we need to see for the economy. That's what we need to see for the stock market. Things getting less worse before they start to get better. We need to see things getting less worse. And that's what the consumers are responding to. And that's why consumer confidence has been so high recently. It's been very good. And then we don't have a lot of earnings till late in the week. The earnings season is starting to resume again. There's that kind of pause. But we have a couple big ones. We got Constellation Brands, which is a big alcohol company. They sell liquor, they sell wine, they sell all the Mexican beers in the United States. We got two classes of stock here. So they're going to report. And of course, consumer staples, we got McCormick Brands, classic consumer staples company. And then we got ConAgra, which is a good ag play. Levi Strauss, we got later. And that's it. So, I mean, keep an eye on these things. Keep an eye on these economic indicators. I always, when I talk to you guys, I always tell you, do your top-down analysis first to see where the economy is going, and then pick your sector. And then, look, there's no reason you guys should be investing in Apple and NVIDIA and Microsoft right now, okay? I'm sorry to tell you that. Those are not the stocks you should be in. Probably these are the consumer staple stocks where, and some agricultural stocks, they're just going to raise prices. And that's all they're going to do. And you know what they're going to do? They're probably going to make more money. I'm willing to bet we're going to see some of these brands do pretty well. And I think the stocks will do okay next week relative to the market. I don't know. I'll talk to you next week and we'll find out. I'll get a report card. But McCormick, Constellation Brands, ConAgra, they're probably going to do okay. You know, when you think about these ag stocks, when you think about the war in Ukraine and Russia and so much wheat is off the market, I mean, we need things like ConAgra Brands to bolster production in other countries here in the West. McCormick Brands, they make a whole bunch of food products. They're probably raising prices right now. And when you think about Constellation Brands, they own all sorts of beer, wine, and liquor brands. Probably doing okay. People are starting to go out more. And I think that probably stock's going to do all right. It's never a high flyer, never a stellar company. And it's kind of a family-owned company. The Sands brothers run it. But they're okay. And, you know, over the long term, the stock does well over many years. So I think they'll do fine. Anyway, that's it. I think that's it. I think that's my last slide. It is indeed. Okay. So I've been on for about, oh my gosh, over an hour. So that's it for me today. Thank you for being here for this market update. I'm sorry if I scared you guys about, you know, some of the things going on in the market, but it is getting scary. So be cautious. Invest in, you know, cautious stocks right now. You know, stick with things that are not that volatile. And then when things get less bad, and they will get less bad soon, then it's time to step back into things like tech and semiconductors and things like that. All right. Okay, so I'm getting direct messages in a text. Does anybody else have any other question? If not, I'm going to see you guys next time. Thanks so much for being here. It's always nice to talk to you about what's going on in the markets. Good luck in our investment competition and any of the other investment competitions in which you're involved. If you have any questions about any of those things, you know where to find me. I'll be happy to talk to you about them. And Adele, I'll be happy to answer your question in just a minute, okay?